Hey, good morning, everyone. Just wanted to say that we're going to get started here momentarily. Well, we're going to give people a couple of minutes to drift on in. We have Brent DeGroot today from OneAmerica. We're going to be going over some great long-term care and long-term care alternative products. Asset-based long-term care is really the direction the industry is heading. I've seen it over and over again. People, worried about long-term care, but not wanting to pay the huge premiums for long-term care insurance just in case they don't ever need to go into a nursing home. Also wanting access to that cash value, or those that don't think about long-term care until it's too late and they can't qualify anymore. That's another great alternative is to go with asset-based long-term care because you can take that money that you would have normally put into an annuity or a life insurance plan and use that for long-term care. So some great options for that asset-based long-term care. I preach it all day, every day to every agent. Look into it, especially with OneAmerica because they are so flexible. I mean, you can put pretty much anything. We could find a way to make it work with OneAmerica, which I love. There's not as many like it's not like a small little rigid box. There are several different ways we can go with it. So that's my favorite part. Looks like we just hit the 10 o'clock and I am all about being on time. So we're going to go through our little IAMS information while we're waiting for people to trickle in. Uh, thank you so much for joining us. Paul was going to be hosting today. However, they are having some technical difficulties down in our Topeka office, so we need someone up here in Omaha to take it over. And Brent is my buddy, so I volunteered readily and said I would love to hang out with Brent on this because I really like OneAmerica and their products, and Brent too. He's an okay guy. All right, first thing I want to share with you is our new producer builders. We have several different levels. So as you start with IAMS and you build your business and you bring in some more, we will help you by reinvesting in your business for you. So any good producer knows that if you reinvest what you make into your business, that your business will grow exponentially. So we're helping you get a little boost there to help you, get moving. Either get you a seminar or some mailers, etc. Whatever works best for your business. So another way you can help build your business is with our referred producer program. Every time I'm on one of these, let me look through and see who I see that has referred someone. Oh, I see ya. Every time I see at least one person that I know has referred an agent over to us. So take advantage of that. If you like the service and support you get at IAMS, we love to have your referrals. And we're not just going to say thank you, we're also going to give you a $50 bonus when you referred agent contracts, and then a little override on them, which won't take anything away from your referral. We also have our marketing reimbursement program where we put in money towards marketing reimbursement to help you pay for your advertising and marketing. Our back office support is unprecedented. I mean, we have the best back office people in the business. They know how to get cases issued. They know what needs to be done. They stay on top of things. They call the carrier so that you don't have to, because trust me, I've done that job and you do not want to be calling the carrier and sitting on hold for 45 minutes. Let us do that for you. Also, our IAMS website is a wealth of information. If you're not familiar with it, get in there, play around a little bit, but always feel free to call your sales director here and we'll walk you through it too. We have great online forums, we have fact finders, we have all kinds of great information on there, rates, quoting tools, etc. Ooh, my favorite thing to talk about, and a lot of producers' least favorite thing to talk about, e-apps. All right, if you are not doing your apps electronically, you are doing yourself a disservice. Trust me, it is way easier. So whether you're using our Luma Firelight, our iPipeline, Sunfire, it stops you from making a bunch of mistakes that you would make on a paper app. I make mistakes on paper apps all the time. I'm always going back and refilling it and refilling it. It takes a lot of time and effort. And then when it goes to the carrier, it takes them 10 days to look at it sometimes. They look at it and then they send it back and then you have to restart. This kind of helps streamline that and you get paid a lot faster. Our creative team is the best in the business. They make beautiful logos, fantastic websites, great brochures and handouts pieces. Talk to your sales director about what they have available and get some samples because you'll be really surprised. Another great thing about their websites and digital solutions is they are super familiar with compliance for insurance agents and for for registered investment advisors. So you don't have to worry about going through a third party that does really pretty websites but doesn't know anything about compliance. So you won't get in trouble. Nobody wants to get in trouble with the insurance commissioner or with FINRA. IAMS Wealth Management. If you do not have your Series 65, you should look into it. You could really increase your revenue, improve client retention, strengthen those relationships. This is a relationship business. It's not a transactional business. It's not like someone walking into your shop and buying a candle. These are, if you want clients to come back over and over again, get them locked in. The more products and services they have with you, the better, and we can help you. So if that's something you're interested in exploring, give us a call and we'll get you hooked up with our IAMS Wealth Management team to see how they can get you going. Our Life and Annuity Academies. Now this next one's coming up April 2nd through the 4th is completely full. However, we're looking at probably early June for the next academy. So give us a call if that is something that you want to get your name on a list for, and we will make sure that we give you, get you that application link as soon as it's available. We get great advanced sales planning, business planning, product information, some really good keynote speakers that'll help you build your business. Is really for the more advanced agents. So if this is something that you think would help you build your business, give us a call and we'll help get you set up. Our trek to Quebec is coming up later this year. You have until June 30th to qualify. I know, oh gosh, there's probably about 40 of you qualified so far, and several of you that are right on the cusp of qualifying. It's going to be an amazing trip. It's just a beautiful castle up there, Le Chateau Frontenac, and it's going to be a great trip for those that have 5 million points. So keep working on that. If you're not sure where you're at, give your sales director a call and we will let you know. All right, this is my last slide before I hand things over to Brent. So I'm going to let him go over this, his information here for OneAmerica. And if you have questions as he's going through, just type those in and we will have a time for questions near the end. I'll also have a poll or two as well. All right.
Awesome.
Everybody should be able to see his screen now. I'm sorry, I was my screen was having some trouble there, but can everybody should be able to see him just fine.
Yep, it looks like from what I can tell, everybody should see this. So thank you, Lisa Marie. Appreciate you turning that over. Thanks for the introduction. Thanks for the kind words that you said as well, Lisa. Really appreciate that. Always love working with you as well. So, and thank you for everybody for coming out today, spending your valuable time to learn about some great solutions that we have in our portfolio that can really help you with your clients and their portfolio, and certainly protecting themselves from any extended care needs. And so I wanted to certainly kick off our webinar that way, I guess, if you will. Next, I'd love to just introduce you to your team, if you will. Obviously, outside of IMES, you've got a team here at OneAmerica that would support you as well. Myself there, Regional Account Director. And then I've got an internal Adam Frechette. And I just wanted to make sure that you all knew who we were. And, you know, again, I always say, go to IMES first. They work with us so closely, and we'll get those, you know, issues or questions or whatever resolved for you. But just wanted to make sure that you had the information there as well. So with that, I wanted to get in and really talk about OneAmerica and why we are an asset-based LTC market leader. Well, largely, first and foremost, I know this slide says 35 years of asset-based long-term care leadership. We've actually been in the business now for 37 years. So why is that important? Well, we've got the longest history in these asset-based long-term care solutions. So really trying to help your clients protect themselves from any extended care needs. But what does that 37 years get us? You know, it's designing plans, administering them, filing them, you know, all the steps, and most importantly, paying claims. And that is, you know, that's where the rubber meets the road. And that is where you are, you know, when you're representing OneAmerica Financial in their solutions, then you are really doing your clients a great service. And I forgot to kick this off this way. Happy St. Patty's Day, everybody. Hope you are going to enjoy that one today. All right, so back to kind of OneAmerica and who we are. Look, we can trace our roots as an insurance carrier all the way back to 1877. So, you know, 140 years, we're a long-standing insurance company. Mutual holding company, and most of the LTC carriers, if you will, are all in that mutual holding space. So we're not, you know, what does that mean? We're reporting to those same policyholders, your clients who purchase a policy with us. So we're not reporting to these stockholders that actually have stock with us. So that just really affords us the opportunity to really look at our block and make it as beneficial as we can for all of those policyholders that you send our way. You see, we've got all the financial strengths there as well. Comdex is 95, A+ rated from AM Best, and the S&P Global AA-. So all very highly rated ratings, if you will. So very happy about that. Now, we've got a lot of flexibility, and Lisa Marie hit this up front. You know, we've got ways of doing it either on a life chassis or an annuity chassis. So, you know, that affords us a lot of flexibility, especially around underwriting issues and that sort of thing. I'm going to give you a couple great opportunities here today to really dive into some of these solutions that we have. But, you know, there's some staples that we've had here as a carrier for many, many years, and that is lifetime protection. So one of the major things that we hang our hat on is our continuation of benefits rider. Haven't got into that yet, but that offers up to a lifetime of protection. And essentially what that means is, you know, somebody puts a plan in place, we can go all the way out to offer a dedicated income stream, especially for any of those LTC expenditures, up to as long as they live. Now, take this with our joint coverage option. Now you can put two people on one policy and also give them that flexibility all the way to protecting them for their life, so they'll never run out of benefits. And that gives the ultimate peace of mind when putting an extended care plan in place. And so we're seeing, you know, of our joint coverage, 60% put on our lifetime COB rider within our block. So when you couple those together, yes, pun intended, again, true peace of mind when doing any extended care planning. When I skipped over there was flexible funding options, and we have a ton of them, and I'll get into those more here in just a little bit. People, yes, we've got 30 regionals, myself included in that number, around the country. And as a resource at the very end, I'll give you kind of a way you can scan a QR code for a map for some of those that happen to be maybe in your area, you know, more closer to home, if you will. I'm based in Omaha, where IMS is headquartered. You know, middle of the country, but we've got wholesalers all around the country. And then lastly, I just really want to quickly touch on our claims benefit concierge. We get a ton of great feedback around this program. These are claims folks, nurses, all in Indianapolis. That's where we are based. And so we haven't shipped our claims, you know, across the, you know, the oceans, and there's no language barriers when a claim, you know, that is such a tumultuous time for a family when that care need first arises. And we get a lot of great feedback just for the fact that our claims are still handled here in the US, in Indianapolis, no language barriers, that sort of thing. So one person for the life of that claim. It is a great, great team that we've got there. And I thought I would quickly mention that. All right, moving ahead, you know, what's driving the demand for protection? And you may be aware, certainly talking with your clients and just working in the insurance industry, financial sector, of, you know, this long-term care piece or conversation is coming up more and more and more. And so really, what's driving that demand? Well, first and foremost, let's look at the aging population. So I'm going to take one here that is a little bit different before I get into any of those other two. Did you know what and this is a rhetorical question, I guess, since we're on a webinar, but did you know what happens January 1st of next year, 2026? The first baby boomer turns 80. And why is that so important? Well, when we look at overall, when claims start in a long-term care situation, it's somewhere between 80 and 85. That's so right in that mix. And now we know that the largest population, the baby boomers, the first one is going to turn 80 next year, and that's 10,000 of them every day after that. So it's a huge demand for this type of protections. And, you know, not only the protection, but people needing care. And so the more people need care, the higher the cost, all of that. So it's better to protect your clients now while you still can. So by 2030, all of the baby boomers will be 65 or older. So all in that planning space, if you will. And then you can see there by 2050, almost a quarter of the population, the US population, will be 65 and older. So big opportunity here. So an aging population, that's going to certainly drive demand for protection, right? Or at least the need for care. Increasing rates of cognitive decline. This has been on the rise for quite some time. So today there are 16.9 million Americans with Alzheimer's or some form of dementia today. And that is projected to rise to, well, basically double by 2060. So that's a scary, scary number. And it's these cognitive declines that are really causing the majority of claims in the long-term care industry. So again, knowing that that is on the rise, always a good thing to talk to your clients about protection while they can still get it, and you know, don't have any cognitive issues, if you will. Personal experience, and that's really what drives the demand as well. They see their own family going through a situation, and you know, 52% say that it's the peace of mind to have that decision in place. Really, you know, drives their need for looking for coverage. So with that, I did want to talk quickly about, whoops, something's going on there. What happened there? Oh, whoops. I apologize. Let's go here. There we go. Oops. Now I skipped ahead. We do consumer studies every once in a while. And so our latest one came out in 2024. The one prior to that was 2022. As a matter of fact, there's a QR code up at the top right-hand corner. So if you want to grab your phone and scan that, you can get the full consumer report that we did put out last year. But here's some highlights of it, you know, and it's really talking about why consumers will put these types of plans in place. but 74% say that they are likely to need LTC in the future, and nearly 2/3 of them say it's a priority. So what does that tell me and tell us, I guess, is that our clients are wanting us to bring this situation up to them, this conversation up to them, not for them to wait for them to come to us, if you will. So again, we need to be planting those seeds. 79% of consumers say that the insurance strength and reputation are key. I talked about our 37-year history in the long-term care space, or the asset planning space, if you will. One of the first to market with these asset planning types of plans. And then 84% say they rate the duration of the benefit period as a key component of that solution. And if you'll remember, one of the staples here at OneAmerica Financial is that lifetime structure, and especially when we're putting two people on one policy at the same time. So thought I would just leave you with some of that. Again, there was that QR code. Hopefully you scan that. If not, you just talk to your marketer at IAMS and we can get that for you. So asset care. Asset care is our life-based chassis for these asset-based solutions. And we did some changes last year, October 21st. The 49 states that we actually offer in, we don't, sorry for those of you in New York, we don't offer any solutions there. But of the other 49 states, for you that are working around the country, all of the blue states that you see there, those 38 of the 49 that we offer, we rolled out a new version of asset care. And that's really what we're going to be focusing on today. However, there's 11 states that are out, that are now working their way through the pipeline of getting approved and rolled out. So some of those that are in the gray states there, you will see that those will be coming soon. And I'm going to say very soon. I can't give you an exact date yet, but those are coming soon. So I think it's still, even if you're in those gray states, it still behooves you to watch kind of what we're going through today. But all of the blue states, this is the asset care plan that is already out. So focusing on what an asset-based solution really is, essentially this is, when these types of plans were first created, it was all a single pay option, right? It was basically a repositioning of the portfolio. And so here's a portfolio. So let's look at the concept of asset-based long-term care in and of itself. So well-balanced portfolio, aggressive, conservative, moderate funds, all of that. And essentially what we're doing with this well-balanced portfolio is just repositioning a portion of that to create their long-term care plan that really protects the rest of the portfolio. Typically, we'll pull these out of the conservative funds because that's really meant to, preserve capital and so forth. But essentially, we pull a portion of that out and create up to a lifetime of protection for them. So here's why many Americans are shifting from the kind of the traditional based long-term care solutions to these asset-based solutions, is because live, quit, or die, they're going to get something for those premium dollars or reallocation of their portfolio. They're going to get something for that money. And what does that mean? So if they live and they need long-term care, obviously now they've got a plan in place. We draw that from either the death benefit on a life chassis or the cash value in an annuity. And I'll get more into that here in just a little bit. But so if they live and need any extended care protection, they've got that, right? If they quit, it's still their asset. The reason we call this asset-based, it's still their asset. They purchase an asset that is theirs, still in their portfolio, and they can always walk away if they want. If they want to quit, they can get their money back. We do have a 9-year surrender charge schedule, but they can get their money back if they want. So if they live or they quit, either way, they're going to get that decision covered. And if they die, one of the biggest things that I had to address when working for a traditional carrier, I didn't even tell you about myself. I've spent 23 years of long-term care protection. So 23 years in the industry of really only focusing on long-term care. A good portion of that, 19, was in traditional carriers, if you will. And so it's been nearly 6 now that I have been here at OneAmerica Financial. And one of the biggest objections that I had to overcome in the traditional market was, well, what if I put a plan in place and I die and I never need it. Well, that's what's great about these asset-based solutions. What it says is this is still their asset, but they've got the protection of, again, a death benefit if they don't need it, passed on tax-free to their heirs if and when they pass, or when they pass, I should say. So they've got that protection of knowing that they've got a long-term care plan in place, but if they don't, it at least passes tax-free to their heirs. Now, on the annuity side, it would be the same way. So even if they used a portion of it, and this, whether that's life or annuity, they could use a portion of it, but if it's not all fully used, that passes on to their heirs. On the annuity front, there may be some taxation to that, but however, on the life chassis, again, it's going to be a death benefit, which would be fully tax-free. So why consumers really like this is because they know whatever they put towards these types of planning options, they're going to get something for the premium dollars they put in. Live, quit, or die. All right, so I talked about funding options earlier. And really, you know, as I said earlier, when these asset-based solutions were first created, it was all single premium based. However, in 37 years of doing this, we have realized that not everybody has the ability to just reposition a single premium or pull it out of a bank or whatever the case may be. So we've come up with a number of other ways that we can fund these types of solutions. First and foremost, recurring premiums. And this is the largest section that we're seeing on our plans, people moving to recurring premiums. Now, we've got a number of ways you can do that. A 5-pay, so pay for 5 years, and then it's a paid up policy. A 10-pay, a 20-pay, all of those same afford there. Pay to 95. Yes, this is a paid up policy at age 95 once they reach there, but really this is our annual pay. So, and again, we can set up all of those recurring premium options on a monthly basis too, if that's the way they really want to attack that, you know, premium options. But lots of ways that we can fund this, and that's really what I wanted to point out. But again, now over 60% of the business that is coming in to our doors today are on a recurring premium basis. 1035 exchanges, so cash value and old life policies that they don't need anymore, we can use that. If it's an annuity, we can 1035 exchange an annuity into our annuity chassis. So we've got a lot of ways that we can fund these even in the 1035 market. And then the last one that we're seeing a lot of interest, I mean, probably over 50% of my calls are on our qualified scenario. So using qualified money. Most consumers have no idea that you can use qualified money to put a long-term care plan in place. Many advisors don't know this as well. So like I said, over 50% of the calls that I take in, week out, are all around our qualified money solution. And that would be personal IRAs, 401ks, 403bs, even inherited IRAs. So a great way to really plan and utilize, put a plan in place for your clients is utilizing some of their qualified money. Now, I will say this, it's about 25% of our business overall, but think about where Americans are saving today. It's all in these qualified assets. We're so top heavy as a nation in qualified funds. Why not just use a portion of those qualified funds to put a plan in place, protect the rest of the portfolio? Makes a lot of sense. I'll get more into that here in just a minute. But I really wanted to talk about some enhancements that we made. As I said, in October 21st of last year, we made some enhancements and really tried to simplify things. If there's one thing that I can apologize for, OneAmerica in the past has made things a lot more difficult probably than they needed to be. And so really we took that approach when updating our asset care for last year, this version, and really simplified things. So you'll see me go into that just a little bit. Flexibility, we kind of talked about that, but I'll touch on some of those things a little bit and more enhanced, if you will. And then we've got the enhanced claims experience, and I'll touch on that as well. The fourth pillar that we're really talking about is competitive pricing. And that, I think, is in everybody's wheelhouse. We all like when it's very competitive. And quite honestly, we had gotten a little bit out of reach of our competitors. So with this pricing update, we are very, very competitive again. So let's touch on those 4 tenets just a little bit further. So simplicity. Very simple. The base policy in asset care, again, this is our life insurance-based chassis. The base policy now pays out over a 2-year period. The reason we see AOB there, that stands for acceleration of benefits. So we're going to take that death benefit and we're going to accelerate that for any long-term care services over a 2-year period. So very simple, no more, hey, does it pay out in 25 months, 33 months, or 50 months? There was a lot of confusion around that. So we have really simplified things. It's just a 2-year base policy. Now, beyond that, we also simplified the continuation of benefits options as well. So many people want, especially if you're on a joint plan, you want more than 2 years of a policy. So do they want to add another 2 years, 4 years, 6 years, or again, where we shine and stand out from our competitors is that lifetime benefit option. So very simply, it's a 2-year base policy. And do you want 2, 4, 6, or lifetime as your continuation of benefits? That's what COB stands for. So the AOB is just that accelerating of the death benefit. The COB means once that original death benefit is exhausted, the continuation of benefits kicks in and continues to pay that same income stream up to whatever amount you want. So much, much simpler. Hopefully you will agree with that as well. All right, flexibility. And I'm really excited to talk about a couple things that we've done here as well. So we are now reimbursing for independent providers. Excuse me. And there's on the bottom right-hand corner there's an example of what an independent provider could be. So really, what we've done with this, we understand in a reimbursement type of solution, which we are, for the most part, and I'll get into that here in just a minute as well. But when it comes to reimbursing, those in rural areas got to be a little bit more of a challenge. And yet, here I am in Omaha. When you get west of Lincoln here in Nebraska, there's more cows than people, right? So in those rural areas, it became a little bit more difficult because an independent providers weren't reimbursed. They needed to be a part of an agency. Well, if that agency's in a small town and the nearest small town where that person is wanting to receive maybe home health care is 2 hours away. So that means they're sending somebody out there 2 hours, may sit there for 2 or 3 with that client, maybe 4, whatever the time frame may be, and then driving back another 2 hours. Just didn't make a lot of dollars and cents wise, right? So now what we're doing is we are reimbursing for independent providers. So they can be, as long as they have the licensure of the state, they can be an independent provider and we will pay them as well. So now in any of those small towns that are out there, there could be an independent provider right there that can get in and provide care. So one of the great things that we've done, great enhancements, is we're doing that for independent providers. Now, one of the biggest difficulties that independent providers had was really billing, how they were going to bill, whatever carrier they happen to be providing assistance for. And so we now have given them an app that they can kind of check in, do all the billing, a very simple process for independent providers out there. And I will say that, it was great in the rural setting, really needed to have that enhancement. But even in more of an urban setting, there may be somebody in that list of independent providers there on the bottom right-hand corner. Maybe they're, semi-retired now or thinking about retiring. Yet they've still got that desire that want to help people. And they decide, you know what, I'm just going to become an independent provider. And they hang their shingle, if you will. Well, now they can be an independent provider. They've got the licensure of the state, and we will reimburse them. And we've got this great app that'll help them as well. So not only in the rural settings, but also in those urban settings is this a major enhancement. Speaking of major enhancements, we are a reimbursement carrier, as you heard me say earlier. But one of the major things that we have done with the new version of Asset Care is added what we call a cash benefit. meaning that when that claim first arises, that's a pretty tumultuous time, as I said, for any family member around that individual. They're scrambling to figure out, gosh, who are we going to have provide care for this, our loved one? Who is going to, maybe step up and help until we figure out who that's going to be? Who are we going to let into the trust to come into the home? There are a number of questions they've got to do. Well, this is the way a caregiving situation typically arises. So follow me here. It's usually, and I'm not being sexist, this is just the way it typically happens. It is the closest female to that care situation need that steps up and says, hey, I'll provide some care. Well, before, we are a reimbursement carrier only. And so it would have to have been a licensed caregiver to be reimbursed out of our policy. Well, now we've got this cash benefit that's available. And you can see it's 75% of the monthly the monthly benefit amount. So for easy math, I'll just say they had a $10,000 monthly benefit amount. We're going to give that family $7,500 up front. They say, look, I want to take the cash while I really figure out a permanent solution, because I want to pay, my neighbor, my family member that's nearby, the friend that's nearby. I want to at least compensate them for any of the caregiving that they're doing while we're figuring out this situation. And that's really what this cash benefit was designed to do. It was really help that family while they're figuring out the permanent solution, at least give somebody the ability to be paid for any informal caregiving that they're doing as well. So really excited about adding that cash benefit there. Now that's only available for our the AOB, the base benefit, so that 2-year portion. However, they don't lose the extra 25% of the benefits. So if the family elects to take that cash benefit from day one, that 24 months is actually going to equate to nearly 32 months, if you will, of care. So they can take cash the whole time for that base policy. And, that would be for a 32-month period, and then get into the continuation of benefits portion, that rider, and then it would go back to the reimbursement schedule, if you will. So love having that cash benefit there, but again, it's really to help that family figure out that permanent solution and at least provide that informal care given by somebody who's not specialized in long-term care services, the ability to be paid in some form or fashion. So to kind of build on that as well, if there are informal caregiving situations that are being done, most of these individuals are professionals in society in some other fashion, right? So they're not necessarily caregivers per se. And so what we have added here as a company, we want to be the carrier that is really helping those families at claim time. And that's really what we're talking about, flexibility, that we have added what is called a caregiver consultant. Now I'm going to call this, for simplicity, a coach. And for those situations, so let's say we've got the nearest daughter to this caregiving situation providing some care. Well, they soon realize that, hey, I've got to move dad who's at least 150, maybe even 200 pounds heavier than I am. How can I move him without hurting him or myself? So that coach, that caregiver consultant, can step in and provide some of that assistance, that knowledge to say, hey, here's a way to think about it. Here's what you'll want to do, or pieces you want to really help you with that caregiving situation. So it's really a coach to work with those informal caregivers on ways to combating some situations that they may run into. So this is paid for by OneAmerica. It's not out of their policy. So it's just an extra benefit that we are doing to really help those informal caregivers, those ones that are not specialized here, to providing that care. And then we've expanded some of the supportive equipment there. You can kind of read some of those. That's pretty straightforward enhancements there as well. So I talked about the whole claims flexibility, right? So I wanted to very quickly put it on the timeline. So the acceleration of benefits, that base policy, if you will, we can either do reimbursement, so that'd be for independent providers, home health care, LTC facilities, or they've got that cash benefit. Remember that. So for informal care, other expenses, they can access the cash portion during that base policy, the acceleration of benefits portion. Once that base policy has been exhausted, their death benefit, if you will, and they're into the continuation of benefits, we are back to the reimbursement side. So why do we do that? Again, we want to provide some care for those unlicensed, or some compensation for those unlicensed caregiving, but we also know the great rate of care burnouts, and especially for those that are not licensed in this type of situation. So we really wanted to help early on in that claim with the cash benefit, but wanting to get that family to that more permanent solution, and that works very, very well on the reimbursement chassis. So support when that family needs it. So we're really kind of surrounding them in a warm blanket. I know we're getting to spring now, and I was using this example when it was more winter and it was cold, wrapping them up in this blanket here, this family, with our care benefit concierge, which I quickly talked about. Again, a lot of great feedback around that. That's how claims benefits start, just one simple telephone call, and that starts the whole process. We've got that caregiver consultant, remember that coach for maybe those informal caregivers early on in that claim period. And then we've got the ability to have a care coordinator as well. And what is a care coordinator? Think of them like a realtor. So if you are moving to a new city or a new state, and you didn't know anything about the real estate market, you're probably going to call a realtor because you want to know a little bit more about what area to move into. Well, that's what a care coordinator is in this long-term care expertise, or this field, if you will. And so they've got all the expertise that is there to help that family, find the best providers that are out there, whether it's home care, whether it's assisted living facility, or full-blown nursing homes. So all three of these are available for those clients whenever they need it. So we're there every step with them for those clients. And then the last thing that I'm really happy to talk about is our price reduction. And there's a lot of information on this slide, lots of numbers. I'm going to boil this down to make it very, very simple. And I'm going to say it is anywhere between a 12 and 15% price reduction. And one of the areas that I'm going to kind of highlight just a little bit there, you can see that 45% decrease down at the very last bullet point, if you will. So one of the areas that we were uncompetitive with a lot of our competitors was when we were adding inflation. And so our actuaries really sharpened their pencils around that. And so that's where the higher amounts of decrease really came, is adding inflation. And so if you're doing any spreadsheeting or anything of that nature, you're going to find that we're going to be very, very competitive in any sector that you are looking for to work with your clients. So again, just remember 12 to 15%, that's probably the easiest way to just look at this slide. So a couple more enhancements there. We still have our 0-day elimination period for home health care. So if they start receiving care at home, no elimination period, which is great. We still have our 90-day facility care side, but those days that they're receiving care are counting towards that facility side. One of the changes that we've made here is that before it was a day of service elimination period, now it's on a calendar day basis. So let's say, they started care, at the beginning of the year, January 1st, and they're receiving care at home. They're almost through their 90 calendar days if they needed to go into a facility. So by the end of this month, that would be that 90 calendar day period. And so there would be no elimination period because that's been satisfied by starting at home, and that 90 calendar day countdown, if you will, has been satisfied for any facilities. And that's just one per insured for the life of the contract. So that's great. To our inflation options of 3% and 5%, we have now added a 2%. That's all compounded. And then we've got either growing for life or for a limited duration, which we say growing for 20 years and then leveling off. That is very price competitive for those that are probably, late 50s, early 60s. Why pay for inflation for lifetime if you don't really need it? That puts you right in that kind of spot where people start to need claim, right at that 80-year-old time frame. So some good options there. Still have a return of premium structure, and that says no matter what reason, if they do a return of premium, they're going to get the full amount of premiums back to them. So still have options there as well. Now, I mentioned qualified funds, and I wanted to give you just a quick example of how this works. Very quick example here, if you will. But here we're going to do a joint policy. Both male and female are age 60. And I'm going to call this, the female here was working for an old, somebody, right? An old job. She had a 401k at, kind of left and retired, just kind of left that 401k growing. Over time now it's grown to 160,000. So this particular couple decide, hey, we're going to use your 401k for our long-term care solution. So what we do here is we take whatever qualified source that happens to be in, do a trustee to trustee transfer over to OneAmerica, and we put it into a qualified annuity with us. Right off the bat, we're going to give it a 25% bonus. And who doesn't like a hefty bonus like that? So that 160,000, getting that 25% bonus now gives them an extra 40,000 just by moving that and putting this solution in place. So what does that equate to? Well, 200,000, right? Well, now we have 200,000 in a qualified annuity at OneAmerica, still their asset, but we're going to use that for their long-term care plan. And what we're going to do is we're going to break that down into 10 equal parts, because we're going to fund a life solution with the COB rider over a 10-pay period, thus spreading out the taxation. Why do I say that there's taxation? Well, remember, these are qualified funds. So some way, somehow, the IRS is going to get their money, right? But we wanted to spread out that tax risk, not make it a whole hit on that 160,000 when it came over. So we spread that 200,000 into 10 equal parts. So each of the 10 years, starting year one, we're going to make a 20,000 distribution to fund that 10-pay base policy with the continuation of benefits rider. So you can see that gives them 177,600 in a death benefit for them. Plus it gives them that unlimited lifetime structure, so that no matter how long their care need lasts, it's going to last for either one of them. So what did that buy them? $7,400 per person per month for as long as either one of them needed. 160,000 buys them 74 per person per month for a lifetime. What a great way to put a plan in place, right? Now, remember one key thing here. Because we're using qualified dollars, we're breaking that up into 10 equal parts, but each of those first 10 years, the clients will get a 1099 LTC for that distribution, because it's going from a qualified source to fund a non-qualified life insurance plan, which is really there for long-term care purposes. So that's the biggest thing that you need to know there. One of the greatest things about these qualified solutions, I mentioned inherited IRAs. So with the great transfer that is going to be happening over the next 20 years, and if you don't know about it, it's nearly $85 trillion is going to be changing hands from the golden generation, the baby boomers, to any of their kids' generations, right? $85 trillion over the next 20 years. So there's a lot of situations where an inherited non-spousal IRA gets moved to a child, right? Well, this works perfectly for the Secure Act rules, which says now you've got to drain that in 10 years. Well, this solution that we have works very, very good for those children that are receiving any of those inherited IRAs, and I thought I would mention that as well. Now, we are also seeing older individuals, because we'll go all the way up to age 80 for these types of solutions. So older clients that don't need their RMD for income purposes, we're seeing them put these in place because this distribution here that is happening over those 10 years, the way we've structured this, that counts towards their RMD calculations. So a couple good reasons maybe to look at any of those qualified money situations you may have with your clients. Now with that, I did want to get into annuity care as well. I know we've got a little bit of time here, but I really wanted to hit on this because there's some great opportunities here with very little underwriting, and that sometimes can be a bear, right? So what am I talking about? Well, the Pension Protection Act. So this has been around now for 15 years, right? Came out in January 1st of 2010 is when it actually was put in place as a law. And basically what the Pension Protection Act did a lot of pension reform, right? But that's not what we're talking about here. There was a small portion of the Pension Protection Act that the federal government realized that this long-term care, this age wave that is coming with the boomers, soon to be hitting 80, January 1st of 2026, and 10,000 every day after that. They saw this age wave coming, what we've coined kind of now the silver tsunami. And they said, we've got to figure out a way that will help those American people fund their long-term care plan themselves. And so within the Pension Protection Act, there was a way of just exchanging a non-qualified annuity. So it said certain annuities could be exchanged for a Pension Protection Act. Well, that certain kind is a non-qualified annuity. But basically, many Americans have these non-qualified annuities in their portfolios today. Some of them are maybe laddered in structure, but eventually they come to a point where chasing the highest rate isn't their greatest need. They're starting to look at this and saying, well, gosh, I'm going to be taxed on every dollar that comes out of that annuity because it was growing tax deferred. And you can see all the taxes that are hitting that: state, federal, Social Security, so that provisional income, their Medicare premiums, IRMA, all of these things can affect every dollar taken out of that non-qualified annuity. So what the Pension Protection Act did is said, okay, Mr. and Mrs. Client, let's just 1035 exchange that into a PPA compliant annuity. Well, all of the annuities that we have here at OneAmerica are PPA compliant. And essentially what that does is it now takes all of the taxation away. So as long as they use it for long-term care purposes, it is all income tax free. So as I said, eventually they age out of chasing the highest rate. What they're really looking for is a tax efficient way to access that money. And why not? This should be your first place to look with all of your clients, in my opinion. You ask them, do you have any non-qualified annuities in your portfolio? Can we talk about some tax efficient ways that we can do that? Now we can just move them via 1035 exchange, very simply, 4-question knockout application. And now we can make that all income tax free if used for long-term care. So a great opportunity for you to work with your clients out there in the annuity suite. I'm sure many of you are already working with your clients today with annuities. So here's a base annuity strategy that I'm going to give you. It only works with two of the three, our original annuity care and our indexed annuity care solution. And basically, we're going to give them instant approval if done through our e-app. Lisa Marie talked about e-apps earlier on in the kickoff of this webinar. I'm going to also, beg you or persuade you, hopefully, to use our e-app, and especially for these 1035 exchange situations, because we made a change internally last year. This was back in May of last year, and we will increase the maximum from 500,000 all the way up to $1 million for these base annuity exchanges. And if done through the e-app, we will instantly approve them after they answer 4 knockout questions. So that is it, 4 knockout questions. And essentially, the first 3 are they needing care today? Unfortunately, in this presentation, I don't have those questions built in, but I'm going to work with Lisa to get sent out to everybody that was on here a great sales piece that we have that shows those 4 knockout questions on the back side, but they're very simple questions to really do. And so this really begs the question, hey, let's look at your portfolio already. You know, we'll go all the way up to age 85 with these solutions. So again, you know, some of those folks that may have forgot to plan for any long-term care services, all the way up to age 85. But with this base annuity, not adding our continuation of benefits, we'll actually go up to age 87 and fully comped all the way up to $1 million. So we can take $1 million, move it from one annuity into this PPA eligible annuity and make it all tax-free if used for long-term care. That's a great solution for you to really be working with your clientele. So I would say this, look at your book of business. Look for the 70 to 87-year-olds, right? And say, do they have a long-term care plan in place? Do they have this tax liability with all these annuities that, you know, that if they access, they're going to pay all these tax dollars on? Let's just simply 1035 exchange them into a PPA annuity, make it all tax-free for long-term care. Obviously, the benefits are there. Oh, one of the things that I really love to talk about as well, once they understand, whether that's you as the advisor and the client, but once you understand the tax benefits of this, the tax efficient strategy, you're going to want to maximize the benefits out of that annuity, correct? So we can actually add what we call an eligible person, must be their spouse, but many of these annuities are singly owned, right? So we still do this singly owned transfer, 1035 exchange, follow the rules, must be like for like. But then we can add that spouse as an eligible person. What that does is now gives both of them the ability to use all of that money tax-free for any long-term care purposes. Yes, they must qualify too, same 4 knockout questions, but this is a great way, a very tax-efficient strategy to working with your long-term care or clients for long-term care situations. So let me give you a couple quick examples and then we'll open it up for questions here. Here's an existing annuity, female, age 77. She has 200,000 in a non-qualified annuity sitting there, grown for years. Maybe she took it out with 50,000 over the years. It's grown another 150,000. That's all going to be taxable, right? We do this 1035 exchange, put it into our indexed annuity care solution. They're not losing anything. These are still going to grow. There's interest rates afforded to them. And we've got 5 indexing strategies that we can do on our index strategy. But look what happens after year 1 of growth. The monthly benefit afforded to the 77-year-old female, $87.62 as a monthly benefit. After year 1, it's grown to $208,000 in the account value, if you will, the death benefit that would be payable if she never uses it. But we also increase the total value for long-term care. So that grows as well after year 1. Well, she's 77. She'll probably live another 10 years, right? So let's look at what it grew to at 10 years. Well, that 200,000 now has grown to 321,000 or 353,000 for total LTC benefits. And look what our monthly amount's grown to, 14,716 per month. So great solution here. The index solution pays out over that same 24-month period. But if she doesn't need all 14,000, that's going to stay, the remainder will stay in her contract and will elongate that past that 2-year period. So I wanted to show you one other example with our original annuity care. The real difference here is it pays out over 3 years versus 2. So we're going to start with some lower monthly benefit amounts, but again, still growth. This could be your great average planning because, you know, a lot of people like to plan for the average, and that's a 3-year plan. So maybe this is the strategy that you want to look at as well. So you can see those numbers there. I won't go through them, but I just wanted to mention these are the 2 strategies that we can do for that base annuity exchange. We've also got one that is built in for our continuation of benefits. This is a little different structure. It comes with extra underwriting. You've got a 5th knockout question. You've got a telephone verification, and we do a script check and MIB check with this one. So this one definitely has more underwriting, if you will, but it's got that continuation of benefits built in, but it's just built-in leverage, if you will. But if you know you've got a client situation that they're kind of questionable on underwriting, I would not even look to adding the COV. I would just do a simple base annuity exchange, pass those 4 knockout questions, which are very simple, and we can go from there. So with that, Lisa, I will see if there are any questions that happen to be out there.
Yeah, absolutely. In fact, there's one that popped up that I'm going to probably take the reins on because it's more of a marketing question. The agent asked, with these stats, why don't consumers come to in-person seminars on long-term care? Um, I like to put my 2 cents in as a marketing expert here that consumers, first of all, in other words, you should think of consumers as clients. Clients don't come to seminars where they are being sold a product. So I see a lot of transactional agents ask questions like this. Agents need to move away from the transactional and into the relational. So it's about relationships and not about transactions. So seminars exist to showcase your ability to make a good plan for potential clients. So to be able to help them to be ready to retire, to be ready for any, surprises that might come their way, including long-term care. But if you are setting up a seminar with just a transactional request, like long-term care, life insurance seminar, then that's the way the clients will see you, as a transactional, as a salesperson, not as a trusted advisor. So my recommendation is that you host seminars with the idea of I am showing you that I'm capable of helping you make a comprehensive plan. And then when you have that appointment with that person after the seminar, then that is where you go over, do you have long-term care insurance? If you do not, that's just one of the questions to ask. Long-term care, your daily needs after retirement, your legacy, all of those things, to make a comprehensive plan that includes long-term care, whether that means a standard long-term care policy or asset-based, which, like I said, usually fits into people's lives more. Do you have any thoughts to add to that, Brent?
Yeah, Lisa, that great information there, and I will just add very quickly. The comprehensive approach is definitely the way to do it. When you do that, at the appointment, maybe after the seminar in and of itself, that's the greatest risk still afforded to that overall portfolio that you've been building with them. But why they don't essentially come, again, if you're just advertising it as a long-term care seminar, every American thinks it's never going to happen, right? We're all in the minority of persons that are going to need long-term care. However, in reality, we're all in the majority of people who will need care, and so that's why it's but they're going to think, they see a piece then it says long-term care seminar, they're just, well, that's never going to happen to me, right? But in reality, it will. So take that consultative approach and protect it that way. So yeah, great comments.
Yeah, good addition to that. I think you covered everything really well. What I'm going to do is I'm going to put up this poll here, that if you have a client with an immediate need for what we talked about today, I'd like you to go ahead and click on that so that we can, I can get you the information that you need in order to, get the, get a an illustration or a quote. If that's something you'd really like to do, um, go ahead and click on that. Also, if there's any questions that we didn't cover here that you didn't get to type in, feel free to give me a call here at IAMS 800-255-5055. Whether it's on the life side or the annuity side. You could also call your, sales director, and any of us would be happy to help. We're all familiar with the products and can get you the information that you need. I'm going to close out this poll. And like I said, if there's any other questions, and it's, getting later in the day, or later, we've been going a little bit here, so I'd like to go ahead and get off the line. However, I am going to be sending everyone some materials that Brent's going to send along. If there's anything in particular that you want to make sure that you see, you can either call me at that 800-255-5055, where you call me every time, or you can also just email me, lisamarie@iamsinc.com, and I would be happy to send you anything that you need. You can also just type in that in the questions, and I'll make sure that you get what you need. Paul will also be helping me with the follow-ups, as he just was unable to get his internet up and running this morning. So happy to fill in. Thanks again, Brent, for me going over this. Some really great things. I learned some new things as well, because of some of the changes. I've, recommended those products multiple times, so I'm pretty familiar. So I really appreciate you going over the more detailed information for us.
Yeah, well, thank you. I really appreciate the opportunity to speak to everybody today.
All
So
right,
have a
thanks so
great
much.
St. Patty's Day, everyone.
You too. Bye-bye.
All right, thank you.